He's Global Chief Economist at Citi. Is the big man here to weigh in on the rates. Mr. Sheets, great to have you with us here. Good morning. Thanks for your time. Prashant this side. What's the message from the Fed? Is it a little confusing at the margin? Or is it dovish? I mean, it's all relative, of course, because last two meetings, the Fed sounded dovish, even though the data that they were sort of coming into those particular meetings was soft. Hot. The labor market data especially. So this time as well, have they looked through it, or are they kind of now more data dependent in that sense? What did you make of it?
I think there were a lot of moving parts today. As you pointed out previously, the soft CPI number was very important. And I think that was dominant in the market response. And that was operating in the background of Powell's comments. So Powell presented his dot plot and said, look, our committee's central tendency at the moment is one cut. But he hardly fell on his sword about it. He emphasized it was a conservative approach. And I really do agree with you that bottom line, what you're hearing from the Fed, what you're hearing from Jay Powell, is they're going to be data dependent. They're going to be empirically driven. And if we get a couple more months of inflation, like we saw this morning, the Fed's going to be cutting rates. And my sense is that very well may happen as soon as September.
Hi, Mr. Sheets. Good morning. Great to have you with us on the show today. So what do you make of the market's reaction? Because clearly the market hasn't been perturbed that rate cuts have been pushed into 2025. Look at the equity market. Continues to make all-time highs on a daily basis. Is this kind of a setup likely to continue? The market seems to have digested this whole pushback rather well.
I think the markets were focused on the CPI print. And I think the broad view is that some of the hotter inflation we had earlier in the year is breaking. And given that, I think that the expectation, as I mentioned, is that the Fed is going to be data-driven, and that's going to open the door for more rate cuts than were in the SEP. So in some sense, I think you can say that the markets were looking through the SEP and downweighting it based on their expectations that we are seeing some improvement in inflation that was not fully factored into those projections.
Good morning, Mr. Sheets, and thanks a lot for joining in on the show. This is Nigel on this side. This is the first time we're speaking post the election results here in India. You had indicated that, yes, the stock markets would prefer continuity because they're familiar with the Modi-led government. What do you make of it now? It's a coalition government. It still appears favorable from a stock market perspective, but I wanted your comment on that one. And also, any comment on the Indian Central Bank? The RBI is in a bit of a Goldilocks scenario, right? Our inflation is cooling. We have growth as well that's fairly stable. So your view on that?
So on the RBI, when you're in those kind of Goldilocks scenarios where inflation cools and growth is solid, that's a place where central banks can be gradual, they can be measured, they can pay attention and wait for something to change. It's kind of an ideal scenario for central bankers. Excuse me. On the election, I think that the number one issue there and the number one takeaway for global investors is that Modi is equivalent to continuity. And broadly speaking, global investors are aware of and comfortable with the investment regime and know how to invest in India. We've certainly seen that over the last several years. And then, as you point out, I think the question is, on the margins, are policies going to be changing in some way because it's a coalition government that might have an effect on either the ability to invest or the attractiveness of investment in India? And I think those are the open questions. But for now, based on where the equity market is, I think investors are giving Modi the benefit of the doubt.
Mr. Sheets, just a quick point that googly which Mr. Powell yesterday, just to go back to the Fed, which he threw in, right? He said that, well, maybe the forecasts, the dot plots, etc., don't incorporate this softer CPI data. I mean, is it really possible? Because you get the data in the morning, the decision is in the evening, so you can always sort of make some changes and take out a fresh printout. You think? Yeah, sorry, go on.
I think Powell was a little vague in his response on that one, and maybe purposely so. But the way I interpret what he was saying is that in the face of the data that they received, that some of the members of the committee felt that the new information was sufficiently significant that they went ahead and changed some features of their forecast. Well, a number of other members of the committee said, 1 month of inflation is not going to dramatically change either my forecast or my expectations for policy. And frankly, we need to be in a world where expectations for the Fed and Fed policy isn't being pushed around by one data point, plus or minus where it lands. But I think everyone on the committee had an opportunity to revise. Some felt it was necessary, others didn't. So I'm not sure I'd play up the staleness of the SEP so much as he said it was conservative, and we'll see if the data justify a more vigorous approach, as I think they will.
All right, Mr. Sheets, we will leave it on that note. A little shorter chat today, but we look forward to a longer one next time. Thank you very much for your views over there. Need to take a very quick break. Come back on the other side with our list of top stocks to watch out for this Thursday morning.